Hi, I'm Billy Gwaltney, and this is the CYA Podcast. This show is for the physician who understands the importance of protecting everything you've worked so hard to achieve. Each week, I'll bring you tips and advice to help you cut through the clutter and misinformation and show you exactly what you need to preserve your income and way of life. If you're ready to achieve the peace of mind that only financial security can bring, let's get started. Welcome to today's episode of the Cover Your Assets podcast. This is your host, Billy Gwaltney, and I'm excited to be with you today. Today we're going to talk about MassMutual's future insurability option compared to their benefit increase rider. There is a little bit of difference between these two, and MassMutual has an excellent contract, and so I just want to cover what the options are so that you can factor that into your decision. And working with physicians across the country, generally, we start out with a policy, or clients will start with, say, $5,000 a month as a trainee, resident, or fellow. And then the policy would include the ability to increase up to, say, a cap of $20,000 a month once they become an attending physician as their income goes up. Again, as covered in previous episodes, there's a financial formula that companies use to calculate how much coverage you can purchase based on any given salary level. With MassMutual, you can start at $5,000 a month and end up at a total of $20,000 a month. You have two ways of doing this. The first one they call the future insurability option rider. This is a rider that's added to the policy where you can increase the policy benefit once you become an attending, essentially on every policy anniversary. You can do this as much as you want, as soon as you're able, anywhere from $5,000 to $20,000 up to age 45. And then there's a reduced amount that you can increase by between age 45 and age 60. But bottom line, the rider stays on the policy to age 60 if you want it. And then as your income increases, you can exercise that, assuming you're not at their cap of $20,000. So this future insurability option rider is an amount of $15,000 a month if you start with a policy of $5,000 a month. This is a favorable approach because there's flexibility. You can increase essentially on any policy anniversary, assuming your income justifies it. The downside to it is that there's a fee for it. Usually it adds about 15% to the rate. And so you're paying for the right to have this option on your policy, and which gives you the right, I should say, to increase coverage as your income goes up. Okay, if you can take it or leave it. If you don't want it, it just rolls forward to the next year. As you exercise amount from that $15,000, let's say in the example I gave earlier, if you have a total future insurability option pool of $15,000 a month, and you exercise $5,000 of that, then $10,000 remains in the pool. The cost for that goes down because it costs more to have a $15,000 future insurability option than it does to have a $10,000 future insurability option. So over the course of time, the cost of that rider goes down. Comparably, they have what's called a benefit increase rider that functions where there are a little bit of guardrails to it. That's kind of the downside. We'll talk about that. The plus to it is that there's no ongoing fee for it. Okay. So you can reduce the cost of your policy by 15% right away, okay, if you'll accept this benefit increase rider. What happens is every 3 years up to age 55, the underwriters, MassMutual, will do a calculation. If I'm your broker, I would help, but whoever your broker is, they should be involved in this to help you navigate through this, to do the financial formula to determine how much additional coverage you might be eligible for at each 3-year interval. Okay, and so whatever that amount is, you can access it up to their cap of $20,000. They have a stipulation where you need to accept at least 50% of the increase in coverage that you qualify for at that time. If you do not accept the 50%, then they're going to remove the benefit increase rider from the policy. Okay, the rider will terminate if the application, including financial documentation, is not submitted in every 3-year interval. So there's on your policy anniversary, every 3 years, you have to go through the process, even if your income hasn't increased. Okay. So it's a requirement that you go through that. Again, your broker can help with this. They should be able to kind of carry the weight for most of the legwork involved in that. It's not that much. And then you need to accept at least 50% of whatever you're eligible to increase by, or they'll remove the rider. Okay. This can be favorable because for two reasons. Number one, there's no cost for that rider. Okay. If you have it on your policy, you don't pay that fee. Again, the future insurability option has about a 15%, give or take, depending on your age and your gender and your specialty and so forth, what state you're in, but ballpark in that 15% range for the cost of the rider. That is not there for the benefit increase rider. Okay. The other place that it's advantageous to consider is that if you are a resident or fellow and you have a length of time before you become an attending and your budget is very tight and you say cannot afford $5,000 a month of coverage right away, which is what these top companies will, and MassMutual included, will allow you to purchase, again, assuming you can pass the streamlined medical screening. So if you didn't want to start at $5,000, you could start at, say, $2,500 or $2,000, some amount less than the $5,000. And with the benefit increase rider, MassMutual will still allow you to have a total pool of future coverage up to their cap of $20,000 per month. If you have the future insurability option rider that you pay extra for on your policy, the amount of that rider is actually a multiple of the initial purchase amount. So if you start at $5,000, you can increase up to $20,000. If you start at $2,500, you can only increase up to $10,000. Okay. But if you started at $2,500 with MassMutual with this benefit increase rider, you could still have a total future insurability cap of $20,000. Okay. I know that's a lot of moving parts, especially if you're just listening to this and not see it in writing. I want to get this to you because it is important to factor in if you're thinking about MassMutual. They have a really strong contract. It's worth knowing what your options are as far as when you go to increase. If you're okay with that 3-year interval, a lot of our clients are because they're typically increasing every 3 years anyway. It's about time to do that. There are exceptions where you don't have to wait 3 years. So if you graduate, say in the second policy year, you can increase your coverage sooner. You don't have to wait for that. So they have certain triggering events that let you increase coverage outside of that 3-year anniversary. But essentially, for the life of the policy up to age 55, every 3 years, you're going to kind of go through this process. And if you don't do it, then they take the rider off. And so that's the downside. Hope you found this helpful, at least to start thinking about. I'd be happy to answer additional questions, discuss your situation in more detail if you would like. My number is 704-270-2376. Again, 704-270-2376. Thank you for carving out a few minutes. I'm grateful for that, and I look forward to seeing you next time. Again, this is Billy Gwaltney. Take care.
This is thepodcastfactory.com.